Welcome to This Explainer. Let's get right into it. Most of us are walking around playing this massive, high-stakes financial game, but honestly, we don't even fully understand the rules. Well, today, we're totally changing that. We're going to decode the invisible forces of the global economy so you can actually rig the system back in your favor.
So picture this. You've just busted your tail all month, right? And you get that sweet alert. You've been paid $2,000. Awesome. But then you check your actual bank account and it says $1,456. You look at the pay stub and it's just a laundry list. Federal income tax, state tax, Social Security, Medicare. It is the classic modern ritual of handing over a huge chunk of your hard-earned cash to invisible forces. And the crazy part is, they kind of expect you to be thankful for it.
Okay, so let's quickly flip through the game manual. We're going to hit 5 key things today: the board, the mechanics, board hazards, your player stats, and finally, a winning strategy. The ultimate goal here: stop trading your time for money and start making your money work for you. Starting off with rule number 1, the board, which is all about value and taxes.
Now, to even play this game, you've got to understand that currency, it's really just a social construct. It is built entirely on shared belief. I mean, a dollar bill has no more inherent value than a random stick on the ground, except for the fact that we all universally agree the dollar is worth something. And to participate in this society we've built, taxes are basically your entry fee. Look, I know they feel like a massive burden, hitting your income when you work, your sales when you buy stuff, and your capital gains while you sleep, but they are quite literally the cost of civilization. They're what pay for the roads we drive on, the schools we go to, and crucially, they ensure your favorite taco truck isn't infested with rats. Even things like Social Security, that's essentially the government forcing you to save money right now so they can pay it back to you when you retire. Same with Medicare stepping in for serious health issues. The reality is, countries with higher tax rates usually see a higher overall quality of life.
Moving right along to rule number 2, the mechanics, specifically banks and interest.
Here's something a lot of people don't realize. When you hand a bank your money, it doesn't just sit in some giant dragon-guarded vault. Banks are essentially extremely clever financial middlemen. The math behind the scenes relies on something called fractional reserve banking. So let's say you deposit $1,000. The bank immediately takes 90% of that, $900, and loans it out to someone else. Maybe a guy who really wants to buy a jet ski. They only keep a tiny fraction of your actual cash on hand. They're operating on the assumption that not every single customer is going to show up to withdraw 100% of their money on the exact same day. And honestly, it's a system that works brilliantly. Unless, a 2008-style panic hits, everyone lines up at once and the whole thing crumbles.
So how exactly does the bank make a profit off that guy's jet ski loan? One word: interest. They lend your cash out at a much higher interest rate than the measly percentage they pay you to hold it. Really, interest is just money's way of charging rent for existing in someone else's hands. When you're the one borrowing, it's a super steep price tag. But when you're saving or lending, it's your reward for being patient and boring.
And that brings us to a massive fork in the road for your finances. Down one path, you've got the slow, agonizing burn of debt. You miss a 20% credit card payment, and suddenly that interest starts earning its own interest. Before you know it, a $12 burrito has evolved into a $50 regret. But take the other path, and you hit the cheat code of investing: compound interest. This is the magic where every dollar you earn creates little clones of itself, and those clones immediately start demanding rent of their own.
The magic number you really want to keep in mind here is 7%. Earning a 7% annual compound interest rate on your investments means your money is literally duplicating itself over time. $100 turns into $200, then $400, and so on. Stick with it, and that compound interest becomes your absolute best, hardest-working unpaid employee. Basically, interest is the silent engine driving all wealth and all debt. It entirely depends on whether you're the one paying it or the one collecting it.
All right, rule number 3, board hazards. We're talking inflation and recessions.
As you navigate this financial board, inflation is the silent killer you've got to watch out for. It rarely happens overnight with crazy fireworks. It's way more insidious. It's a slow erosion where your $5 bill just gradually buys fewer and fewer instant noodles. Sometimes it kicks in because there's just too much cash floating around. Think about it. If 2,000 people all want a $500 TV, but the store only has 1,000 of them, the store's just going to raise the price to $800. Boom, inflation. Other times, it's supply chain hiccups driving up production costs, or even just the public's expectation of rising prices that sparks a weird spending frenzy.
When this gets out of hand, the government has to step in and hike up interest rates just to cool the whole economy down.
But what happens when things cool down a little too much? You get the economic cycle. Think of the economy like this massive, raging party. During the boom phase, everyone is out on the floor dancing. Then you hit the peak, and the lights start to flicker. And then comes the bust, a recession. This is a painful stretch, usually at least 6 months, where the DJ suddenly switches to sad lo-fi beats. You see corporate downsizing, layoffs hit hard, and everyone basically just stops spending money. But you've got to remember, this is just a reset. Eventually the spending comes back, businesses rebuild, and the growth engine starts up all over again.
Which brings us to Section 4, your player stats, namely your credit score.
To survive those crazy economic resets and actually be able to borrow money effectively, lenders rely on this kind of shadowy algorithm to judge your financial trustworthiness. The funny thing is, it doesn't care if you're actually wealthy. It literally just wants to know, will you pay a loan back before it's marked light? That's it. It calculates this using your payment history, how much of your available credit you're using, the age of your credit accounts, your mix of different loan types, and any new credit you've applied for. Honestly, you should treat your credit score like a high-maintenance pet. You can't just ignore it. You have to actively care for it and feed it good habits, or it is going to make a massive mess of your financial life. It's all about looking good on paper to the lenders.
This algorithm spits out a 3-digit number, somewhere between 300 and 850. If you're dropping anywhere below 580, you are basically a walking red flag to a bank, and they're going to charge you severely for the risk. But if you can cross that 750 mark, suddenly you are just sparkling with adult credibility. You're primed to buy a house or score a low interest rate on a car without getting absolutely crushed by hidden fees.
And finally, rule number 5, the winning strategy, investing. To truly win this game and outpace that inflation we talked about, you have to make a major shift. You've got to transition from trading your time for money, which is always a limited one-to-one exchange, to trading your money for more money. And the way you do that is by diversifying your assets. You don't just put all your chips on one square. You can buy stocks, which literally gives you tiny slices of ownership in real companies. You can buy bonds, which is basically you playing the bank and loaning your money to the government or a corporation in exchange for interest. Or you can dive into real estate, buying a property with the goal of having someone else pay you to live in it.
Now, I know a lot of people get completely spooked by the stock market because it feels risky. And yeah, markets definitely go up and down. But listen closely. The real danger isn't losing money in the market. The real danger is watching inflation quietly steal your future purchasing power. If you refuse to invest, you are essentially guaranteeing that your hard-earned cash turns into worthless monopoly money as the everyday cost of living just keeps going up.
It all ties back to what we said earlier about money being a construct. Value is entirely perceived. I mean, gold is just a shiny yellow rock. It's only valuable because humans collectively decided it is. Think about Steve Jobs. He created massive perceived value with the iPhone, and millions of people happily handed him thousands of dollars. It's the exact same psychological reason Gucci can take a handbag that looks like it belongs in Target, slap a logo on it, and charge 100 times the price. If you can create or even just invest in immense perceived value, you can capture a massive amount of wealth.
But to really lock in that wealth, you need the ultimate form of leverage, and that is time. True wealth isn't built in days, it's built in decades. Time is without a doubt the single greatest force in wealth building. By consistently investing over, say, a 30-year period, and just letting that compound growth do its thing in the background, completely ordinary people earning modest paychecks can totally rig the system and retire with 7 figures.
So there you go, we've officially decoded the rules. You now know how taxes fund the board, how banks and interest work as the underlying mechanics, how to brace for inflation, manage your credit score, and actually multiply your wealth through smart investing. So the only question left for you is this. Is your money sitting quietly, slowly eroding in a checking account, or is it out there actively multiplying? You know exactly how the game is played now. Your next financial move is entirely up to you.